This is Brad Hettich with Commercial Lending X, and I'm coming to provide you with breaking news today related to the major changes that were announced by the SBA to the SBA loan programs last week. Now, I'm coming to you with these changes today with a little bit of egg on my face because I just produced a video a couple weeks ago where I said I didn't anticipate a lot of major changes to the SBA program with the new administration. And these changes were much deeper than I was expecting, so I apologize for that. However, it was much deeper than pretty much all the lenders I've been talking to were expecting as well. So I do want to dive into those. I've really narrowed it down to 25 major changes that I think are most important and have the biggest impact. And we have put together a summary document with these changes that is available to review, and we will get that out as well. Now, I do want to point out two things related to these changes. First, a lot of the changes were rolling back some of the operating procedures to what they used to be prior to the last administration. So these are not all new changes. It's kind of rolling back to the old rules. Secondly, I am already hearing there's going to be some clarification and some additional changes to the new rules that are likely to be released in the next week or two. What those are, I do not know yet. Now, I wouldn't get your hopes up that it's going to be overhauling all the recent changes they made. I think most of it is going to be some clarification on language and maybe fixing some places where there's inconsistencies and providing better guidance to the lenders. But once we hear what those are, we will definitely get an update out with those changes. So without further ado, I'm going to run through the biggest changes that I think are the most impactful, and then I'll quickly summarize some of the other changes after that. So the first change is the clarification from the SBA that not only can no owners of any businesses getting SBA loans be non-US citizens, but also you cannot have any employees that are not here legally within the United States. So this rule states that all owners need to be US citizens or permanent green card holders, and you can't even have any sort of foreign ownership via foreign entity. They're going to look through whoever the underlying owners are and are going to want to be sure they all hit that citizenship requirement. Secondarily, there's been two major changes to the SBA small loan program. First, the maximum loan amount has been reduced from 500,000 to 350,000. So that's going to make it a little bit harder for some people to get financing. Secondly, that program has a scoring system in place. The minimum score required went up from 155 points to 165 points. So it's making it a little bit harder to qualify for that small balance program. Now, even if you don't hit the underwriting criteria, you can always do a standard SBA loan for a loan below 350,000. You just have more underwriting that you need to go through and more closing requirements than you do with the small balance program. And of course, you can always do an SBA 7A loan from 350 and above. So the fact that the limit's been moved down to 350 doesn't impact most borrowers. The franchise directory has returned. That is a big change. Now, the franchise directory had been in place for years and was just gotten rid of about a year ago by the SBA under the previous administration. Now, what the franchise directory does is it requires all franchisors and certain distributors to qualify with the SBA and be approved by the SBA. Now, if a franchisor or certain distributor is not on the franchise directory, then an SBA lender cannot lend money to those franchisors or minority distributors. So this is a big change. Now, historically, not all franchisors were on the directory or were part of it. And that's because not all of them want to comply with some of the SBA rules that they need to comply with. Now, there is a period for compliance to happen here. It all has to happen by July 31st, and there's some interim rules that still allow SBA lenders to work with franchisees or distributors that are not approved. But come July 31st, there are going to be franchises that are no longer going to qualify for SBA financing if agreements can't come together between those franchisors and the SBA. The SBA has also brought back the credit elsewhere test. So this is a rule that been in place for a number of years and was gotten rid of just about a year and a half ago. And really, what this rule states is that if the SBA lender can prove that you would qualify for credit elsewhere, then they should not be qualifying you for an SBA loan. And just because you can get an extended 10-year term on an SBA loan doesn't mean that you should then qualify for that SBA loan. The people that this rule is really going to impact are those that have liquidity that is substantially higher than the loan amount because they should qualify for financing elsewhere or could self-finance the deal, or people who have substantial outside assets they may be able to leverage to qualify for financing without having to go the SBA route. Ultimately, with the previous rule, we didn't typically find it hard to get deals done via SBA financing, but still, this will present a hurdle to some individuals that may have some higher levels of liquidity or assets, but we're hoping to take advantage of the SBA program for some of its other benefits. The SBA has also brought back the minimum down payment requirement of 10% for startup businesses or new businesses. Now, this rule had been in place for a long time, but was also gotten rid of about a year and a half ago. Now, I don't think the impact on this rule change is going to be big because the majority of SBA lenders were still requiring an equity um, down for business startups, usually 10%, sometimes more, even despite the previous rule change. But that change is officially back in place that you need 10% equity for business startups. Now, this doesn't apply to business expansion. So if you're expanding your business, you can still get away with zero down on a business expansion. There have been a number of changes, pretty major changes to partial business acquisitions. The first is you can no longer do a partial business acquisition as a multi-part acquisition or as what's typically referred to as rollover equity, where the seller is rolling equity into a new entity. All future partial business acquisitions have to be done via stock or uh, business membership purchase. It cannot be done as an asset purchase. You can still do an asset purchase on regular business acquisitions, but just not partial business acquisitions. In addition, anybody involved in the ownership is required to be a co-borrower based on the new rules. So what that means is every individual who's going to own stock is going to be signing personally on the loan. In addition, any sellers that retain under a 20% ownership interest will be required to guarantee the loan for 2 years. And if they retain greater than a 20% ownership interest, they have to guarantee the loan for the life of that loan. This is even impacting, or at least appears to impact, minority investors that are coming in as new owners. So historically, if you were a minority investor backing a buyer and maybe you'd own 1, 5, or certainly under 20%, you were not required to be either a co-borrower or a guarantor on the loan. The way the current language reads is you are now required to be a co-borrower and or guarantor. I think this was a mistake. Some of the language related to this is contradictory. Ultimately, I think this is one of the areas that will get cleaned up in the coming weeks. But at least for the moment, it does create quite an issue for buyers that were looking to bring investors into their partial business acquisition. So we're going to have to see how this rule plays out. Now, for general business acquisitions or full business acquisitions, the SBA has updated the equity requirements. You now are required to bring 10% equity down on all total business acquisitions. Now, you can still get away with less equity down by utilizing a seller note, but the minimum equity down now is still 5%. So you can't get below 5%. You can't get to 2.5 or 0% like you could previously under the old rule changes from about a year and a half ago. So you're going to need a minimum of 5% down. Now, the other 5% can come from a seller note, but that seller note needs to be on full standby for the life of the SBA loan. Under the previous rules, it only had to be on standby for 2 years. Now that is full standby for the life of the loan. That's going to be a much harder pill for some sellers to swallow. So I do think that this is going to create an issue, and I think we're going to see more deals requiring the 10% minimum equity component. As it relates to business partner buyouts or partial business acquisitions, the equity requirements have been updated there as well. The way the rule now reads, and I apologize in advance, this is a bit confusing, so bear with me. But if you are doing a partial business acquisition or a partner buyout, if the balance sheet for the company in the most recent year end, as well as the most recent quarter end, shows a debt to net worth of 9 to 1 or less with the new debt rolled onto that balance sheet, then technically you can get away with zero down on that acquisition. Now, first off, that doesn't mean lenders are going to allow zero down. Lenders may still require equity into the transaction, but you can technically get away with zero down. Now, if that debt to net worth ratio is above 9 to 1, then you either need to bring sufficient equity into the deal so that debt to net worth ratio will be 9 to 1 or less, or you need to bring a minimum of 10% equity into the transaction. So that again applies to both partial business acquisitions and partner buyouts. So there is the opportunity to get away with less debt down in those situations. And then the last major change is on approved sources of equity. The changes that took place about a year and a half ago were allowing equity to come from borrowed funds. That is no longer the case with this most recent update. If you can use borrowed funds, but you have to have a source for repaying those funds outside of the new business. So you can't be using cash flow from the business. You can't be using a salary you're drawing from the business to repay those funds. So you're going to have income outside of that, whether that's spousal income or another job you have that would repay those funds. Now, where this is going to have the biggest impact is on using home equity dollars as part of your down payment for a business acquisition or to start a business or expand a business. If you're borrowing those funds at time of acquisition or starting a business, you're going to have to be able to source so you can pay those funds back via another source of income. If not, you're going to have had those funds, sitting in your account for 60 days or longer. So it's sourced equity at that point. Typically, if you've had it for 60 days or more, lenders aren't looking at what the source is anymore. So those are the biggest changes, the most impactful changes. A handful of smaller changes that could be an impact I'm going to cover quickly. First, the SBA has provided greater flexibility to lenders with their preferred lender status or PLP status, where they can approve more loans directly without having to submit them to the SBA. So that's going to increase the number of loans that can get processed directly by PLP lenders instead of having to go to the SBA. And the SBA has also created a streamlined process for issues that may come up in those approvals, for questions, as well as for exemptions that lenders might need without having to submit the whole deal to the SBA for those items. The SBA has made some additional clarifications on the use of passive real estate. This specifically applies to like ghost kitchens, also would apply to salon suites. Before, a lot of these entities weren't allowed to borrow money. Now, if they meet certain requirements in their operations, they do qualify for SBA financing. So that's a change to the positive. Certain businesses that are under management agreements will no longer qualify for SBA financing if that management agreement gives full control of the business to a third party. So this could impact some situations like maybe some medical service organizations or other similar businesses. So you're going to have to be sure you as the borrower are still in control in order for them to qualify for SBA financing. The SBA has updated their rules related to businesses that sell CBD products and marijuana related products. So, still selling marijuana is not allowed and you don't qualify for SBA financing. But if you're selling products around that industry, so long as they are legally approved products, those businesses can now qualify for SBA financing. Also, if you have a criminal record, the SBA has provided some guidance on how you can qualify for SBA financing with that record. So that's a positive. Another big change is all SBA loans need to be current in order to qualify for additional SBA debt. And they've defined current as no payments more than 30 days late or payments no more than 29 days late, or at a maximum 29 days late, the way the SOP reads. This even impacts loans that have matured. So if you have a loan that's matured and is more than 29 days past its maturity date, that debt will no longer qualify for SBA financing. So you're going to need to get that loan temporarily renewed, and you're going to be needing to make payments on that loan. Typically, the lenders and the SBA is looking for 12 months of consistent payments. So deferred payments aren't going to work either. You're going to have to be making your standard payments on your loan. The SBA is now requiring date of births when pulling authorizations. That's a new change. I think it's just going along with trying to verify who individuals are. They're also requiring equity formation dates to pull authorizations. If you're going to lease space for your business, there's a couple updated requirements there as far as what documents the lenders need to get if you're making improvements to that space. In addition, if the tenant is reimbursing you, excuse me, if the tenant, you are receiving a reimbursement from a landlord for any improvements made, that reimbursement has to come back and pay down the loan. So unless the landlord makes those improvements directly on your behalf and pays for them on your behalf, if you have to pay for them and then get reimbursed, that reimbursement has to come to the lender to pay down the loan. Now, the lender can fund that reimbursement, but obviously that's going to come back to pay down the loan. Life insurance is now required on all loans with a loan amount of 350,000 above that are not fully secured by hard collateral. So that's a change. There were some limitations previously on when life insurance was needed. It's been broadened, so life insurance is going to be needed much often on SBA loans. And lastly, there's been some clarification on the rules related to the information banks need to get if you're buying a division of a company or a sub-entity of a business. Before, the SBA was really still looking for tax transcripts. Now tax transcripts are not required. Lenders can make decisions based on third-party account reports and a whole series of other requirements. So that's going to make it easier to get partial business acquisitions done if you're buying a division of a company or you're buying some sort of sub-entity that flows through the business. So overall, as you can tell, there's been a lot of changes. Hopefully, I've given you a good summary here. As additional updates come out or additional news related to changes or anything else happening in the lending world, I'll be sure to get an update out to everybody. But in the meantime, if you have questions, hit our website, commerciallendingx.com, or don't hesitate to email me at brad@commerciallendingx. We're here to assist you with your financing needs. We're still getting deals done. We're pushing stuff forward. So however we can help you, please let us know. Thank you for watching today and have a great day.